Welcome to Mad Money. Welcome to Cramer. Doing friends, I'm just trying to make a little money. My job, not just to entertain, but to educate, teach it. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Maybe you hate Jay Powell. Maybe you love him. Maybe you have no idea who he is. Regardless, what you need to know is that he's in charge of the Federal Reserve. So he controls what's known as short rates. That means the short-term interest rates there are like the ones you borrowed today and pay you back tomorrow. The president appointed the head of the Federal Reserve, and in this case, it was President Trump who hired Powell during his first term. Trump now thinks Powell's doing a terrible job because he won't cut interest rates. So the president takes jabs at him every chance he gets. Unfortunately, this presidential obsession has a lot of impact on the markets. Today, for example, we got hit on rumors that Trump will fire Powell, and then the market came back when the president said it's not true. Dow only gaining 231 points, S&P advancing 0.32%, NASDAQ climbing 0.25%. Now, I thought the sell-off on the rumor and the sharp rally on the news of the president letting Powell alone was dispositive, and I'm going to tell you why. Why? The president wants Powell out. But when we got a whiff of the rumor that he'd take action, longer-term interest rates went up, with the sacred 30-year Treasury going from 4.97% to 5.07%. Now, that was done in an hour. I know it's small, but you know the direction. The direction is for interest rates to go higher. Bad. At the same time, the S&P 500 went from 6,254 to 6,201 on the rumor, but then rallied back to 6,263 after the denial. Good. So clearly the stock and bond markets don't want Powell getting ousted. That's night and day, right there. Boom. Now, is Powell the issue here, or is it that Wall Street's terrified of the idea that the president might be able to fire the Fed chief, something he's not supposed to be able to do? Legally, he doesn't have the authority, but the Republicans control all three branches of government right now, and Trump's their guy. Of course, there are still institutions that are concerned about Federal Reserve independence, but they're financial institutions, not the political ones. The financial institutions don't have as many divisions as the political ones, and they never will. What is rarely talked about is why Powell even bothers to stay. What's the point of taking this? Now, as someone who's had his share of national ridicule, it's not something you look forward to. But when you look at the action in the stock and bond markets today, how we went down when the rumor was first floated and went up when the president walked it back, it's worth asking why stocks didn't soar when we thought Powell was getting fired. Soar. Stocks are supposed to benefit from lower interest rates, right? You cut rates, you get better business formation, you get stronger employment, housing market gets stimulated by teaser rates. So why didn't stocks blast off when we heard Powell, who is standing in the way of all that, was sacked? Why didn't the market go up? Legit question, one that I think the president has to be pondering. But therein lies the problem. The market, at least today, is saying that Trump might be very wrong about firing Powell. What's the case for firing this man? We spoke to presidential advisor Peter Navarro last week, and he thinks a good reason to fire him is that he's got a terrible track record, according to Navarro. 2018, Powell took rates up in the face of incipient weakness. 2021, he didn't take rates up because he thought that inflation was transitory. I'll admit that Powell's not perfect. Nobody bats 1,000. But we have to ask, should we judge him harshly for holding rates steady right now? Or to put it another way, why hasn't Powell started cutting rates again? We had a cooler than expected PPI number today. That could make it easy to justify a rate cut, right? But how about inflation? The incredibly important consumer price index from yesterday had some prices that had some signs of inflation from the president's tariffs. Higher prices for clothing, furniture, cleaning products, food away from home, meats, poultry, coffee, gasoline, even soft drinks. That's a long list. Now, is the tracing right? Appliances and canned fruits and vegetables went up because of tariffs for certain. We know from ConAgra that the price of tin cans went higher. Tariffs on aluminum make cans, including soda cans, more expensive. Korean and Chinese appliances went up in price because of that steel tariff. That helps give Whirlpool an edge, but it hurts you because you're going to have to pay more. Coffee, imported, so the fall of the tariffs. Meat and poultry, that's more problems with the herds and flocks. Furniture, the move out of China raised prices. Same thing with clothing. Tariffs are the issue. Against all this, though, if you know where to shop, not something that they put in these numbers, Amazon, Walmart, TJX, Costco, the prices are tame. Come on. Score one for the president. However, we don't know how high the tariffs are going to go, and he seems to roll out new ones every day. We don't know if there's going to be doublings or even triplings on some countries. We haven't seen the car and truck tariffs that we all fear. We haven't seen how much the imported parts of a house drove up the price of homes. We're nowhere near finishing tariffing. And that's what Powell wants to wait for. That's why he's on hold. He's prudent. Score one for Powell. So what's the case against Powell's patience? If you believe the economy's about to fall apart, then there's no time to wait. But we just heard from the big banks over the last 2 days, not one of them said the consumers hurt. A lot of that's because it's still incredibly easy to find a job. Sure, there are lots of layoffs at the banks themselves, but there aren't a lot of white-collar workers without jobs. I find it very hard to worry about a downturn when employment's at 4.1%. That's the problem with President Trump's position. The Fed's supposed to cut in a slowdown, but we don't have a slowdown. And the only thing that might cause one is the president's tariff policy. It's a paradoxical Mexican standoff. If Powell doesn't wait, if he cuts, front-running the August set of tariffs, he'd be caving. And if he's wrong, he'll look like a fool. He has absolutely no reason to cut other than to stop the heckling. What's in it for President Trump if he tries to fire Powell? I think we saw it today. Nothing. The stock market would get rocked. Long-term interest rates would rise. What president would want that to happen? If I were President Trump, I'd wait to see what happens with his tariffs. As long as inflation's stable 2.5 months from now, then by all means, bash Powell for refusing to cut rates. But today should have been a real wake-up call. For who? For the president. He does himself no favors if he fires Powell. Even if you thought Powell was a doofus, which he most decidedly is not, you would still be fighting all the usual enemies who cherish the Fed's independence. I'm one of them. It's been good good policy for our great nation. It's worked. Ain't broke, don't fix. So, Mr. President, write down this one, May 15, 2026. That's when Jay's done. His loyalty is clear. It's to the country. You can't beat that. Plus, this whole rap about how Powell may have spent too much money on the Federal Reserve renovation. What is he like? The guy is like it's not his house. Trump's credibility is hurt by this. Does Powell look like a guy who cares about this stuff? Does he look like a contractor? Honestly, the guy's so intense about his job that if you told me he didn't even choose the color of paint in his own office, I'd believe you. Bottom line, I hope today is the last day that Trump goes after Jay Powell, whose term ends in 10 months anyway. Got it for Powell only hurt Trump the same way it hurts the markets. And I don't think the president's a masochist. At the end of the day, we're either going to see more inflation or not. If inflation really does pick up, firing Powell won't matter because the rest of the Federal Market Committee won't let him cut either. Mr. President, sometimes, this is genius by me, it's better to leave well enough alone. Hey, let's go to Tom in Illinois, please. Tom!
Hey, Jim, thanks for taking my call.
My pleasure. What's up?
I wonder what you think about Sony. I know the government's coming after Japan with tariffs. How do you think that'll affect the stock?
I don't want to be there. I don't want to be there because I think Japan's going to get the brunt. Too many soldiers there. We've done too much for them. I think that Japan and Korea, the next wave, is what I think that Jay Powell's worried about, too. The next wave is going to be really, it's just going to be,
House of Pain.
Sell.
The House of Pain.
Let's go to Rick in Illinois, please. Rick.
Jimmy, how are you today?
I'm having a pretty good day. How about you?
It was okay, except for this Powell announcements during the day. It's a little bit upsetting, but we move on. Jim, I've been an acolyte of yours since Cramer and Kudlow.
No, that's not possible because it was Kudlow and Cramer. I lost the coin flip. I wanted Cramer and Kudlow. I mean, let's just tell the truth. After 25 years, it's time to tell the truth. I wanted Cramer and Kudlow. So did my dad. All right.
So did I.
What else? Yeah.
And
what can you do?
And now I'm a member of the club. And my question to you is, what's with Micron? They reported earnings. They were outstanding, made a new high at 137, and now it's like they're going out of business.
I got to tell you, I look at it every day. Do you know I said what's with Micron 3 times today? I think that run from 70 to 130 really got people spooked. I don't know. Now everyone's talking about how the chart's bad. I'm with you. I think the stock is inexpensive, but you know what? The chart is saying we got to wait. I'm going to obey the chart. I just am. I'm going to obey the chart. And anyway, I like NVIDIA. Let's go to Anthony in Florida. Anthony.
Hey, Jim, I just want to tell you I'm a member since day one, and I love the 1020 meetings. I do not miss them with you and Jeff. They're really great.
Jeff works so hard. Jeff, when he goes out to lunch, he goes out for like 30 seconds. It's incredible. The guy is so intense. I love it. I sit right next to him, and he is so dedicated to the club. It is fantastic. He's dedicated to you. How can I help?
Oh, I appreciate it. I'm 60 years old, and I still got some time to stay in the market, and I want to get some dividends. And Verizon is my company that I have. What do you think about Verizon with a 7% dividend?
I think it's okay. It's really just a bond. I mean, there's a lot of competition now in the telco business. I wrote this book, How to Make Money in Any Market, and I had to default to a lot of the real estate investment trusts and to a lot of the master limited partnerships in the oil market. Those are the only place where I see really great value in dividends right now because the stock market has run so much. It's a quandary, but those are the way to be able to answer the quandary. All right, look, I'm hoping President Trump cools it with the too late pal rhetoric. I find it seems too insulting for me. At this point, I think he's only hurting himself. And, of course, the markets, too. On Mad Money tonight, with earnings season kicking off, as always, with the financials, I'm digging through the top and bottom lines of all the reports and giving you my take on the big banks. Then lots of surprising stocks have been rallying lately, but I found one that I think takes the cake. I'll reveal what it is and whether you should take a cut of the cheese. And we have the big banks reporting strong numbers. But what about the regionals? I'm getting the latest with the top brass first horizon. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Over the past 2 days, we've heard from all 6 of the financial institutions that I lovingly call the big banks. The 4 big money centers, JP Morgan Chase, Wells Fargo, Citigroup, and Bank of America, and the 2 big investment banks, Goldman Sachs and Morgan Stanley. Every time earnings season kicks off, I like to go over the big banks because you know what? They tell us a great deal about the economy, what's going on, whether the Fed should be cutting or raising rates. You get the picture. This time the banks came into earnings season hot. I mean, like maybe even way too hot. With year-to-date gains ranging from a 7% one to for Bank of America to nearly 25% for Goldman Sachs. In other words, the bar was high. So even though most of them reported good numbers, sometimes they weren't good enough to satisfy Wall Street's elevated expectations. Let's take them one by one. Starting with JP Morgan, the biggest bank on earth. They, by the way, 3 times bigger than the next. I mean, that's kind of crazy, isn't it? Reported on Tuesday morning, delivering a clean top and bottom line beat. Loan loss provisions were lower than expected, although their net interest income came in a tad light. CEO Jamie Dimon proclaimed that, quote, each of the lines of business performed well, end quote, though technically the 2 largest segments, consumer and community banking and the commercial and investment bank, beat expectations handily, while the smaller asset and wealth management business was basically in line with expectations. Nothing wrong with that. At the same time, JP Morgan raised its full-year net interest income forecast by $1 billion, also raised its expense guidance by $500 million. For once, Jamie Dimon had good things to say about the U.S. economy, taking up the big, beautiful budget bill, but also throwing some cold water on us, citing risks from tariffs, trade uncertainty, and the budget deficit, Fed independence. What else? JP Morgan just announced a $50 billion buyback last month after the stress test results were released, and they could do more, but would rather not if the stock gets too high. There's a lot on the one hand or the other stuff right here. John Ford would love this bank. Look, the shares dropped $2 yesterday, but there was nothing really wrong here at all. It was another good solid quarter from industry leader JP Morgan. Wells Fargo reported the next one, and this one really ruined my day because we own it for the charitable trust, and Wall Street hated the results. Even though the sales and earnings were better than expected, some of that was from lower provisions for credit losses, offsetting the bank's softer than anticipated net interest income. Wells even cut its full-year forecast for net interest income, caused people to dump the stock in droves, and me to hit the linoleum floor, always dirty, with the cheap scotch. Now, on the company's earnings call, management tried to explain this change was intentional. Now that Wells Fargo is no longer limited by the punitive asset cap, they're prioritizing their institutional business. Think sales and trading. So whatever they lose in net interest income, they expect to make up in fees. Still, the change clearly caught everybody off guard. And I didn't think they really explained it that well, hence why the stock dropped more than 5% yesterday. Still, I'm sticking with Wells Fargo for the charitable trust, which you follow by joining the CNBC Investing Club. I hope you do. In fact, after yesterday's pullback, the trust upgraded Wells. We had it as a 2. We took it up to a 1, meaning we think the stock can be bought right now. Boom! Ultimately, I trust Wells Fargo CEO Charlie Scharf, who's really good. I think he can get the bank back on track. It's never really off track, but you know what? It had that asset cap. It went away, and now I think they got so many things going. It wasn't communicated well. They need an analyst meeting. With the asset cap going, Wells has a bright future. It's just they have, I call it, a messaging problem. Now, also on Tuesday morning, we heard from the Sandy Bank, which is Citigroup. This ended up being the best received bank quarter of the day, with the stock jumping 3.7% and hitting a 16-year high before pulling back a bit today. Not only did Citi report a big top and bottom line beat, their net interest income was much, much higher than expected, more than $1 billion above the consensus estimate. I don't know why the estimates haven't caught up yet to what's going on with this bank. That's the real issue about why it keeps surprising. All 5 of Citi's segments grew in the quarter, with the best growth coming from the wealth management business up 20%, their investment banking business up 18%, and their markets business up 16%. I got to hand it to them. Even better, management says they've made significant progress on their turnaround efforts, and higher costs from the turnaround should start to come down next year. That's a big reason the stock caught fire. CEO Jane Fraser's turn is working. And as long as the bank keeps avoiding big setbacks, doesn't get injured, I bet the stock can keep climbing. After all, Citi's still the cheapest in the group by a pretty wide margin. It's got a lot more to run. Next this morning, Bank of America reported a good quarter, but it was the weakest of the 4 majors. While the bank managed a bottom line beat, it was the only one of the 4 that missed on the top line, thanks to a nasty net interest income miss, but it wasn't that big a miss. That said, Bank of America managed to maintain its full-year net interest income forecast, which helped blunt the impact of the miss and why the stock didn't get hit that much. I was a tad disappointed with B of A's markets and banking segments, both of which fell short of expectations. In a quarter with so much volatility, their sales and trading business should have been printing money, but it didn't happen. The company's shares had already declined nearly 2% yesterday, fell a little bit more today. I don't know. I can't get excited about it, I guess. Now, the single best report of the big banks came from Goldman Sachs. Buy. Another travel trust holding really bailed me out of this one. Now, it got me off the dirty linoleum floor sipping this stuff. They changed the owner of this, the CEO of this today, and back with what I like. Pouring the best of the best to celebrate what was the best of the best. Goldman blew away the numbers. I think they may have had the best quarter ever for most of the divisions, thanks to the red-hot global banking and markets division. That's the investment bank and the sales and trading operation. Investment banking up 26% year over year. Equities trading grew 36%. Fixed income, currency, and commodities, which sometimes really blows up the joint, trading grew 9%. Big story, though, right now is the return of M&A, as M&A advisory revenue grew a staggering 71% year over year. 48% just versus the previous quarter. In an appearance on CNBC this morning, CEO David Solomon explained that Goldman's corporate clients gained confidence in the quarter as the quarter went on, indicating that the strength in M&A is just getting started. That is so terrific for stocks, I've got to tell you. We're going to see some big M&A now that we've got common sense regulators. In the end, the stock rallied more than $6 today. And you know what? I think it's going to be up much, much more. You know why? Because it is just the cheapest when it comes to EPS. More on this one later. Also this morning, we heard from Morgan Stanley. A healthy top and bottom line beat. All 3 of the divisions, institutional securities, wealth management, investment management, beat expectations. And by the way, the wealth and investment management business here is on fire. They continue to see big inflows. They now have $8.2 trillion in combined total client assets. Sticky, fantastic business. Overall, very solid set of numbers from Morgan Stanley. Well, why did it roar? Well, I think the company's actually hurt by the fact it reported the same day as Goldman Sachs. Goldman had a stronger performance than everybody in investment banking, sales, and trading spaces. Yet even Goldman couldn't rally all that much today, so it's no surprise that Wall Street shrugged at Morgan Stanley's report and the stock pulled back 1.27%. That's not a lot at all. Again, nothing wrong here. It just looked like they're less enticing right now than Goldman's numbers. Bottom line, overall, I'd say that we had a generally strong reports from the big banks, overshadowed, by the way, by the speculative stocks, the stocks that are somehow related to Ethereum or Bitcoin. It's that kind of thing that's winning, even as the banks, to me, showed me that they could go up for a very long time. You can throw this stuff away. It's all this. Mad Money's back after the break.
Coming up, Cramer's looking closer at the Cheesecake Factory's recent run. He'll be back with his opinion quicker than it takes to browse the menu. Next.
This market's got a lot of winners that feel like they came out of nowhere, don't they? I mean, stocks are always checking, trying to figure out what they are. I mean, last night I talked about IMAX. Well, we're just making a fortune because it's the best way for struggling movie theaters to sell tickets. Today I got another one for you, just kind of popped out of nowhere on my screen. Cheesecake Factory. Yeah, it's up over 31% year to date, trouncing the 6.5% gain in the S&P 500 over the same period. Cheesecake Factory. So once again, I'm asking, what the heck is going on here? It's not obvious that Cheesecake Factory would be cleaned up right now, is it? They have 350 locations across the U.S. and Canada, anchored by their flagship brand, of which there are 215, although they've got a bunch of others, like a North Italia, an upscale Italian chain, Flower Child, fast casual chain where everything is locally sourced, all natural, made from scratch, and the Fox restaurant concept, which is more of an innovation lab for new brands. So what's the secret sauce that's driving this thing? Whether you're a regular customer or not, Cheesecake Factory is infamous for one thing. It's ridiculously large menu. It's over 20 pages long, roughly 225 different items at any given time. Of course, when you take away the roughly 45 different cheesecakes and other desserts, it's slightly more manageable. But they've still got a sprawling lineup of foods. You can't get enough of those avocado egg rolls. Basically, Cheesecake Factory covers all the bases, making it a good choice when you're looking to go out with a group of friends. This is quite literally the safest option because nobody's such a picky eater that they can't find something to order here. As analysts at Goldman Sachs put it, this diverse menu eliminates the, quote, no vote when deciding where to go out to eat. Plus, with its wide variety of price points ranging from $12.95 for a cheese flatbread to $31 for steak frites, there's a value here for everybody. That's crucial in this environment. Throw in Cheesecake Factory's massive portions that have you leave them with leftovers, plenty of leftovers. And the value proposition here is clear. If there's one thing the winners in the restaurant space have in common right now, it's that they offer a great value proposition. I mean, given the size of the stuff, it's almost like you get 2 meals in one, provided you use the doggy bag, which is what my father's business was. And look, even if you're not a fan, it's hard to argue with Cheesecake Factory's annualized unit volume of $12.5 million. And that's what they make per share, and it's an obscenely large number for the restaurant industry. Everyone does marvel at these guys' profitability. High average unit volumes are great, but converting them to higher profits is even better. Luckily, management's been focused on doing just that by investing in their workforce with the goal of making the Cheesecake Factory a better place to work in order to retain talent. On the last conference call, management proudly shared that they once again been named to Fortune magazine's 100 best places to work for the 12th consecutive year. They got the same strategy as Costco. It's only cheaper to pay your people well because hiring new employees and then spending months to train them is a huge waste of money and really hurts the profits. At the same time, if you consistently retain your best people, that's generally good for the numbers. As management explained on the last conference call, recent operational performance and notable results were driven by our talented team and our ongoing focus on staffing and retention. Management went on to say, quote, during the first quarter, we saw further improvement in our already industry-leading manager and staff retention, which we believe directly contributes to outstanding guest experiences, overall restaurant performance, and ultimately sales growth. And in fact, first quarter guest satisfaction scores improved both sequentially and year over year, end quote. Hey, look, it's hard to argue with those results. The customer's always right. I'm calling this the Costco philosophy, but this is also very much what we heard from Kevin Hochman. He's the CEO of Brinker, parent company of Chili's, when he was executing his big turnaround. And look, Cheesecake Factory hasn't just been relying on improved service to jumpstart this recent rally. The company's also been making changes to the menu, something they usually do to keep things fresh, just in case you were sick of the 225 items already. Part of this, the main reason, really, that these semi-annual menu changes help the company is they stay on top of any hot food trends. As one J.P. Morgan analyst astutely noted on the last conference call, citing his hard-hitting research of going to the restaurants and trying to all the new items, much of these new dishes are very vegetable-heavy. That's smart. I can confirm that this analyst is right, although here at Mad Money, we use the more cost-effective method of looking up the changes online. Jamie Dimon might have to revoke that analyst company's card. But it's true, they added a ton of vegetable dishes, giving you a few more ways to avoid that no vote from your more health-conscious friends or my vegan daughter. At the same time, Cheesecake Factory's also changed the menu to offer their customers better value, something that they're planning to stick with going forward. The result, when Cheesecake Factory reported its most recent quarter at the beginning of May, they delivered impressive unit-level margins of 16.6%. Wall Street was only looking for 15.8%. Meanwhile, they're planning to open 25 new locations. They're in growth mode this year across all their brands, although only 3 or 4 of these will be Cheesecake Factories, which isn't much given that they currently have 15. The other concepts are doing the heavy lifting. Management expects to open 6 to 7 of these North Italia locations, 6 to 7 at Flower Child location, and as many as 8 to 9 FRC restaurants. Of these other concepts, they're no joke either. North Italia's unit volume is 7.75 million, Flower Child's 4.6 million. So adding new locations will be meaningful to the overall earnings. This comes out to 7% unit growth overall, which is enough to make this a pretty compelling restaurant growth story. So I like the company. But where do I come down the stock right now? This thing has been red hot. Although with Cheesecake Factory set to report earnings the Tuesday after next, it might be wise just to wait and see the latest results. While performance has been strong, management's remained conservative in its outlook, so the stock might sell off even if they have a real good quarter. Despite delivering a top and bottom line beat and these impressive margins when they last reported, the stock slipped the day after earnings thanks to management's commentary that, quote, the environment doesn't feel as robust as maybe 3 months ago, end quote, with their second quarter revenue outlook coming in below consensus expectations. So let me give you the bottom line on Cheesecake. Even though management's been pretty conservative in their outlook throughout this rally, I don't know if it would be prudent for me to tell you to buy Cheesecake Factory ahead of the quarter, given the stock's rallied 30% since those comments about deteriorating environment. And it's done so on very little news. There's a lot to like about this story, but let's see how they did last quarter. As much as I want to say let them eat cake, maybe let this one cool off before you take a bite. Let them eat cake. You think I didn't do this whole thing so I could do that? I just wanted to say let them eat cake. Okay, let's go to Larry in Florida. Larry.
Hey, Jim.
Larry.
So I'm studying for the bar down here, and I've been eating a lot of pizza. I just wanted to know what your thoughts were on Papa John's.
Okay, I'm into fitness. Fitness pizza in my mouth. I love Papa John's. It's fantastic. And I think that, look, here's the thing. The only problem with Papa John's is they changed management. The really great guy went over to, from Papa John's, he went over to, to the company, the Shake Shack. Went to Shake Shack. And you got Todd Penegor there. And Todd, he's a really good guy, but he was at Wendy's before. And I have watched what Shake Shack has done since. And I think that Shake Shack got the better end of the deal. It's been really fabulous since Rob Lynch moved over there. So I'm going to have to say we have to wait and see. I like the pizza, though, very much. But I need to see how Todd does there. He's new. And that I couldn't think of Shake Shack immediately. That's just, I think I got it. I had Danny Meyer on my brain. Let's go to Greg in New Jersey, please. Greg.
Booyah, Jim. Greg again.
Hey, man, what's up?
All right, all good. Maybe a little unfortunate, but I'm calling about the maker of the Baconator. I know that there's a new CEO in town. The old one left. Maybe you could give me a little news on Wendy's.
I'm not. Look, other than the fact that my wife loves Wendy's so much, it's just ridiculous. I'm not liking this stock. I mean, they cut the dividend, and already the dividend now is 5%. There's something very wrong at Wendy's, and the answer is you do not want to touch it. That happens to be a very tough industry, the burger industry. You want to stay away from Wendy's. All right, there's a lot to like about the stock of the Cheesecake Factory right now, but I'd wait a month or so before taking any action. I want to see that quarter. Now, much more Mad Money ahead, including my Switzerland regional financial player, First Horizon, has been so good all this time. Then there's prevailing so-called wisdom on Wall Street that's been bugging me today. I'm taking another look at the stock of one big bank, and I'm going to tell you why I think the broader sentiment is just plain wrong. Of course, all your calls about fire tonight's edition of the Lightning Round. So stay with Cramer. As we move through the bank portion of the earnings season, please just don't focus only on the big banks. Look at the regionals like First Horizon, Tennessee-based bank that's becoming one of the top players in the Southeast. Like most bank stocks, First Horizon had run up pretty dramatically going into the quarter. It was up roughly 40% from its early April lows. But the company was still able to deliver a strong enough quarter to make the stock rally this morning. It was a small revenue beat plus a nice 3-cent earnings beat off a 42-cent basis. So what drove the beat? And more importantly, can the stock keep running? Let's dig deeper with frequent guest Brian Jordan, the chairman, president, and CEO of First Horizon. Find out, Mr. Jordan, welcome back to Mad Money.
Thank you for having me. It's great to be here.
So, Brian, once again, it just sounds like your customer base is pretty strong, wants to continue to do things, obviously worried about the same things everybody else is in the country. But otherwise, the consumer and the person who wants to grow the business seem pretty positive.
Yeah, I would say, given where we were 90 days ago in terms of the market reaction to Liberation Day, the customer has really become very encouraged and very confident over the course of the last 90 days. Momentum has been building across the quarter, and I think we have very good momentum in the economy, broadly speaking, as we transition into the third quarter and the back half of 2025. So customers are very optimistic and leaning in.
Okay, so this is something I've been wrestling with. I see, I talk to many bankers, and many of them are saying, you're a little more positive than most because you have a great franchise in a great area. But I'm not hearing anything which just says, you know what, the Fed should cut rates. At the same time, I could argue that 4% is too high in history. So what do you do with the historical nature of the rates are too high versus the customer confidence and how business is going pretty strong?
Yes, I look at the data and I find that I can argue it either way. You can cut rates or not cut rates. And I think we're at that inflection point, and I suspect that sometime over the next 6 months, the Fed will settle on a direction, and in all likelihood, that is a cut or two potentially. I think the customer has become broadly comfortable with the level of interest rates. There's certain sectors like commercial real estate that are much harder to make work with higher interest rates and would benefit from lower rates. But I think customers are learning how to deal with whether it's higher cost of imports or whether it's higher interest rates. There's so much good going on in the U.S. economy that customers have continued to be optimistic and really look through that and see the potential for the long term.
But at the same time, your CFO said, when I saw how bad the mortgage data was just from last week, I guess the question is that a one-week trend? Or are we going to see continued decreases in mortgage originations? Obviously, you got a big mortgage origination. You have a warehouse business. She didn't sound that positive.
Yeah. If you look at our business, the percentage of purchase money mortgages have drifted up. It's, I think, 75, 78% in the second quarter, 22% refinance. So the high rates has really stifled mortgage originations. But our team has done a really nice job of consolidating market share. Purchase money activity continues to be pretty steady. So the combination of the seasonality and purchase money activity in the second quarter, people buying homes, and the fact that we've consolidated some share, our balances have been strong. And as we look out, we think they'll be strong in the third and into the early fourth quarter.
Well, do you need short rates to go to 3 let's say, for things to go even faster? Or do you think that it wouldn't matter if the short rates are 3 because you're talking about long rates?
Yeah, I think if rates drop in, call it 50 to 100 basis points, and I'm not advocating as much as I am, I think our business is very balanced. You'll see different parts of our business pick up and perform. Our fixed income business will benefit, and you'll see a steeper yield curve. I think what you will ultimately see is mortgage refinance and mortgage origination activity start to pick up. Commercial real estate, which actually contracted on us in the second quarter, will start to grow again, and people will start new projects, whether it be in warehouse or industrial or whatever it happens to be. So I think lower rates would actually accelerate growth in the economy. It's hard for me to anticipate the interplay between rates and tariffs at this point because there's still so much being settled. But all in all, I think lower rates would have a stimulative effect in the near term.
Yeah,
absolutely.
I think so too. I do not blame anyone for waiting to see what happens with tariffs. They change every week. But once you're over tariffs, if you're not cutting rates, then there's something wrong with it. That's the way I feel. But now let me ask you a question. I heard something that was disturbing to me today. I did not know that J.P. Morgan was 3 times the size of any other bank in the country. Now, we have a kind of an informal rule that you can't have more than 10%, whatever. That seems wrong. I'm thinking about why doesn't Brian Jordan build a national bank? And instead of the big 4 that report, why don't we have First Horizon be the 5th?
Yeah, there's no way to make that math work, I think, is the short answer. I think there's a real opportunity in this middle market space that we are. We do have 2 or 3 very large, significantly larger financial institutions in the U.S., but it's still a banking system made up with 4,000 plus institutions, and the needs that we all serve are slightly different. I think there's a very good place for us in this middle market space where we're serving those companies that are middle market, commercial, Main Street organizations, consumers. And our footprint, given where we are concentrated in the southern United States, is a fantastic place to do business. So I think over time, you'll see further consolidation in the industry. But for where we are today, we think continuing to generate and invest capital in our existing franchise is the thing for us to focus on.
Okay, one last question. You did 2 times ago, you came on and said there's a lot of newcomers coming in. Yeah, you have to defend your turf, but don't worry, they're really short. They're really short timers. Did they turn out to be short timers, or some of these guys decide to be a little less aggressive?
Well, I think you still see spots of aggressiveness, and you can pick up the paper any day of the week and find somebody who's building branches in the South. And if I were not in the South looking to grow, I'd be looking to grow in the South as well. So it's not unexpected. It is a competitive a dynamic that we're very comfortable with, we're accustomed to, and it has not been problematic. And I think our team did a fantastic job serving customers, growing the business, growing our deposit base, and controlling our costs, particularly deposit costs, in the context of all the competitive dynamics that are here.
Terrific. Well, look, another great quarter from you. That's Brian Jordan, Chairman, President, CEO of First Horizon. Brian, you're always a great calming voice in a market that always seems to have something going crazy. Thank you so much.
Thank you.
And money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. So the way around Christmas, my draft rules are the same. This talking about my buy, so it's not really clear. I don't know the top questions at a time. My staff person was really playing it down. And then the lightning round is over. Are you ready? Ski that to the way I'm going to start with Lewis in Pennsylvania. Lewis.
Hi there, Jim. I'm from outside Philadelphia, near the home of your buddy Jeff Lurie. Are you picking up
it's nice over there. It's nice there.
How
Howard Roseman lives over there. It's fantastic. What's going on?
Yes. What do you think about new goals?
It's okay. I mean, why not buy Agnico Eagle? That's the one I really, really like. They're doing so well. Let's go with Agnico. I need to go to Chip in Mississippi. Chip.
Hey, what's up, chill man?
Not much. How about you? I'm chilling. It's pretty hot out here.
I'm chilling. Hey, listen, I heard Blue Horseshoe liked some QBTS, so I bought some that's done really well over the last couple of weeks. My question is, do you think I'm better off selling my rig, which seems like I've been averaging down for a year and a half?
I want you to own this D-Wave. Here's why I want D-Wave, because one headline, one little story, and that stock goes up 10 points. I mean, I'm looking at stuff that is going up 10 points on nothing. And D-Wave has the ability to be able to do that because it's actually a real company. Let's go to Rick in Wisconsin. Rick.
Hi, Jim. Rick from Wisconsin.
All right,
Love
Rick, what's
show.
up? Thank you.
It's my first time in Cramerica.
Oh, good to have you.
My worst performing stock.
Send you a trip
My worst performing stock does have a nice dividend, but isn't doing much else in a bull market. Although it was up today, should I sell, hold, or even add to Bristol Myers?
All right, Bristol Myers, never seen it this cheap. We're holding it. I did have high hopes for their, what I would say is their central nervous system drug. It better work. If it doesn't work, we're going to get rid of it. And it will be a disappointment, and it will be a shame. Let's go to Chad in Wisconsin. Chad.
Hey, Jim. Thanks for taking my call.
Of course, Chad. What's up?
Hey, I had to get your thoughts and opinions on this under-the-radar stock. It's currently rated by many as a strong buy by at least 12 analysts. It's a Bitcoin fintech energy infrastructure company. It's rated about 50% below its price target. Even JP Morgan, Chase, and Citi have much higher price targets. It seems like it's on the verge of a breakout. What is your thoughts on CleanSpark?
Okay, all right. CleanSpark is another one of these stocks that, I mean, frankly, I didn't even know JP Morgan followed that one. I'm not so sure they do. It's another one of those stocks that one headline is going to roll. So I now say it's okay to have a speculative. Look, you can speculate with it as long as you understand that it's speculation and nothing more. Let's go to Greg in Michigan. Greg.
Booyah, Jimmy Chill.
Yo, man, what's
here?
What's happening?
Hey, listen, I've been watching you for 20 years and look forward to watching you 20 more, my man.
All right, I'll go for it then.
Thank you for all you do, and thanks for everything. I recently retired. I've been watching this company for a little over a year. Did a big, fat, juicy dividend of 13%, and it's called Flex LNG.
Yeah, I've been trying to figure out why that has such a big dividend. Let me go to work on that for you rather than just say, well, I think that dividend's safe. We got to find out. When you see a dividend that high versus the rest of the market, there might be something wrong. We're going to get on it. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, even when a stock is down, it may not be out. Cramer speaking out against the market's prevailing thought pattern when it comes to post-earnings declines. Next.
Stock is down. It must be something bad. That's how everyone thinks during earnings season. It's like one big echo chamber. It's astonishing to watch. Far more often, it's totally backward. If a stock is down, you might be better off assuming it's a buying opportunity. I know that sounds like a really ridiculous orthodoxy, but it sure makes sense when I see, like, on my screen, the banks and what's going on. Take Goldman Sachs, a company I worked at, know very well. One reason we own it for the Charitable Trust. Whenever I get with fellow Goldman alums, and I do, we're current members, I do that too, among the first things that come up after you talk friends and family is how cheap the stock is. Remember, lots of people use really sophisticated metrics involving return on tangible equity and the efficiency ratio to measure banks versus banks. I don't pay it that much mind. I am at heart a price to earnings multiple man. I spent about 24 pages in the soon-to-be-released How to Make Money in Any Market on how brilliant the PE multiple is when you're trying to compare apples to apples. The craziest thing is that Goldman, a fabulous firm, trades at a big discount to the average stock in the S&P 500 because its earnings used to be so episodic. Notice, used to be. This is something that CEO David Solomon has worked hard to change. And this quarter showed how the company's become much more of a well-oiled machine where you're going to get a number that doesn't swing wildly good, bad, or indifferent. I think this is the beginning of when the stock gets reevaluated upward, and the multiple has a giant upward revision, and that's going to propel the stock much higher. Rocket ship.
House of pleasure.
So today, when I saw the stock down at one point this morning after Goldman reported a blowout quarter, a truly blowout quarter, I went ballistic at our Investing Club morning meeting show and said, enough already. When it's down, that doesn't make it bad. When I saw Goldman down 6, I said, someone wanted to buy 100 shares, buy 25 now, buy 25 a little bit lower, and then buy 50. That's called pyramid style of buying. Gradually getting bigger as it goes down. Why did I have to give that instruction? Because when a stock starts to go lower, it will often keep going lower until all the people who don't know anything are done selling, and you get a terrific price from their ignorance. We saw that with Goldman today as the stock eventually rebounded and finished the session up more than $6. This was their best trading quarter in history, and it's a great trading firm. Very strong wealth management, beginning of a turn in M&A and IPOs. That's really all you can ask for from Goldman, and it's the stuff that's going to make the stock a much higher multiple stock, and I like that. All right, the number of times this kind of thing happens in earnings season is truly insane. People just don't have the time to investigate, so they presume, and very often they get it wrong. Here's what I want you to do. I can't promise that every decline is a mistake. While there are many mistakes made, plenty of stocks go down because they deserve it. But if you own a stock and you see it go down, first check the conference call transcript. Then put it through a chat bot and ask if anything went wrong that you might have missed. I like ChatGPT and Perplexity to do that. The good ones will tell you what lines may have been a disappointment. Ask it to compare Goldman to the others in the industry. If it checks out the way I saw it check out, then the answer is you need to do some buying on weakness. Why? Because the weakness won't last for long. I like to say, as always, bull market summer. I promise I find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.